Hey, good morning, options traders. Well, a risk that I see a lot of traders stepping into is when they're looking at what are called their risk graphs or their expiration curves, but they're doing it for strategies that have multiple expirations. And they're not quite sure how to interpret these graphs. And if you're not sure how to interpret them, you're going to think that your strategy behaves one way when it really can behave quite differently, especially when you get to expiration of the short option. So for example, let's start with a profit and loss diagram. On every single profit and loss diagram, and your broker's platforms should supply these to you, you're going to see two lines. And one's going to be called the expiration line because that shows your profit and losses at expiration. And there's another line that's called the today curve, sometimes called the current curve. You might even hear some traders call it the now curve. So for instance, here is a long $100 call. And you all know by now that we get a bend right here at our strike, right there at 100. So this blue line is our expiration graph, which means it's showing us the potential profits and losses at expiration of our call option. However, this red line is what's going to happen to us today. So if you want to know what your profit and losses will be today at different stock prices, find your stock price, trace a line up to the current curve, and look left, and it's going to tell you what your expected profits are at that stock price today. Now, of course, these have to be generated off of a pricing model. But if we're at expiration, right there, we're on the blue curve, we read it exactly the same way. And we're going to say, if the stock gets up here to 110 at expiration, how much profit will I have? Well, trace a line up to the blue curve, look to the left, and in this example, you would have a $5 profit. So these graphs are all red according to your questions. Do you want to know what your profits will be today or what they'll be at expiration? So of course, as time goes by, this red curve is going to slowly sink down into the blue curve. And then right on the expiration bell, it just becomes that blue curve. So this is the way that most of the graphs look when you're looking at a single expiration. But this is not true when you have different expirations. So let's take a look at a strategy. Let's say a calendar spread. And to enter into a calendar spread, you will buy a longer dated call and you will sell a shorter dated call against it with the same expiration. So for instance, let's say that you buy a March $100 call and you sell a January $100 call against it. This will always be a debit trade because longer dated options have to cost more money. We've got the same strikes. So that's what it would cost, and of course that would be your maximum loss. But you must understand that when you're looking at your expiration graph, it is drawn at expiration of the shorter term option, which might seem kind of weird, but think about it. You've got two different expirations going on. And where do you draw the expiration graph? Could we draw it at the expiration date of the longer one? Sure, we could draw it at any point in time. But as a convention, they are always drawn at the expiration date of whichever expiration is coming up next. So if you have a strategy that has multiple expirations, whichever one is next, that's when that graph is drawn for. So in this example, if you buy the March 100 call, sell the January $100 call, this might be what your risk graph looks like here in blue. And of course, this is the current curve. And then as time goes by, if the stock stays here in the center, this red graph is going to start slowly moving up. That's from your positive theta there. And you will start capturing this profit. However, remember, this is not what your strategy looks like all of the time. This is the mistake that traders make. When they put this strategy on, they think this is what their risk graph looks like all the time. It only looks like this up to the expiration date of that short contract. So let's say that the stock closes below the strike, in this example 100, at 100 or less at the expiration date of the short option. Well, if that's true, then that short option, the one that you wrote, is now worthless. And what does that mean? It means you're just holding a long call. So again, your risk graph doesn't look like this upside down V, assuming that you didn't roll this out, you go through the expiration, this expires worthless. Monday morning, this is what your graph looks like. Quite a bit different. We're now bullish. We went from a neutral position to bullish. And that's because we're now just holding the long call. On the other hand, let's go back to the original risk graph that we're looking at. Let's say that the stock closes just above 100, even by a penny, and you don't do anything about it. You just go right into the expiration bell. What's going to happen? You're most likely going to get assigned. And if you're short a call, what does that mean? It means you will sell 100 shares of stock. What if you don't have the shares of stock? Well, remember, the exercise is always for the shares. So what will happen is that you would be short shares of stock plus your long call. And so you will be short shares of stock plus your long call. And so that is a synthetic long put. And that means that your risk graph is going to move from this upside down V in blue to this. You're now a synthetic put. So think about it. On one hand, the stock closed below the strikes. Monday morning, you are bullish. It closes just above. Monday morning, you're bearish. Big differences in those positions. And so you need to understand what's going to happen at expiration, if you're likely to get assigned, and how you can roll those positions out so that you don't end up with an unwanted position. So just be aware of that whenever you're looking at your risk graphs, and if you've got multiple expirations, unless you're able to instruct the platform otherwise, it is always going to be drawn at the expiration of whichever option is coming up next. And then if that's true, you have to say, well, what happens if that option is in the money or out of the money at expiration? Will it expire worthless, or will I end up buying or selling shares? And if I do that, what will be my resulting risk graph? Because if you can't answer those questions, you could end up with very big unwanted positions on Monday morning. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.